And so we know that the prospectors, if they get it right, if they find the gold and they can build a business around that unique data set that they've acquired, amassed, built, licensed, they can build tremendous defensibility and advantage, extract economics as a result of that, and build really big businesses. I mean, really, really big businesses. The reality is there is no prototypical founder, and we've not been able to figure out the set of personality traits that would suggest that one founder could be successful or not. And that's what I think most people miss, which is the opportunity in some way should dictate the experience and knowledge and personality type of a founder.
Hello, everyone, and welcome to Fintech Leaders, coming to you from New York City. I'm your host, Miguel Armaza, and I'm a co-founder of Gilgamesh Ventures, a venture capital fund that backs early-stage fintech entrepreneurs in the U.S. and Latin America. If you enjoyed this conversation, I invite you to leave a review on Apple Podcasts, Spotify, or wherever you get your shows so more people can learn about Fintech Leaders. In this episode, I sit down with Charles Moldow, general partner at Foundation Capital, a 30-year-old venture capital firm with over $3 billion in assets under management. Charles joined Foundation in 2005, and over the last 2 decades has led early-stage investments for many companies, 14 out of which either went public or were successfully acquired. Some of his investments include Lending Club, DOMA, Rappi, Rover, and OnDeck Financial. I learned a lot every time I talk to Charles, and I hope you'll enjoy this conversation as much as I did. We discuss why data is the new gold and a framework on how to invest in the sector, the reason why different market dynamics require different types of founders to succeed, thinking selectively about credit-driven fintechs, valuable portfolio and liquidity management lessons, and a lot more. Charles, welcome to Fintech Leaders. I'm glad we're doing this officially on the air for a second time, although it's been a long time since our last one.
Yeah, this should be like our 6th time by now. That was too big of a gap. That was probably pre-double even. That was like a while ago.
Yeah, it was a long time ago. I feel that the world has changed in a way. But Charles, let's just get started with a minute or two about your background. You've been doing venture for a couple of decades, but before that, you had another career you were building. So maybe tell us a bit about your career, and then we have a lot to talk about on what are you working on these days.
That's funny that you asked me about the kind of 20 years ago, because somebody asked me that question the other day. They wanted a bio. And I went and I looked on my LinkedIn and my bio on our website, and it talks all about my venture career, which has been 20 years, but it stopped there. And then it said, I'm an avid golfer and I'm a baseball coach. There's actually a full career prior to venture that ran 12 years. And I actually had to go back and write kind of like a bio to cover that decade plus. But yeah, when I came out of business school, I worked at the largest cable company in the country, worked for a guy named John Malone, a very famous media mogul. And while at TCI, we saw the internet very early. We saw Netscape early in the browser. And we realized that there needed to be a company to work with the cable industry to offer internet access to the cable infrastructure in the same way that AOL and Prodigy and CompuServe were being delivered into the home through the twisted pair of a phone company. And so I left TCI in Denver to come to Silicon Valley, started At Home Network in 1995, and built that company over a 6-year period, took it public in 98. We acquired the search engine Excite for $7 billion in 99, and we sold it to AT&T in 2001. So that was like a start to finish, amazing experience. And then after At Home, I went and joined some ex-Netscape guys who were starting a company, and I was lucky enough to pair up with them and to be one of the kind of members of the founding executive team. And I should say they, because they had started to build it before I got there, but built basically Siri 20 years ago, 25 years ago. And we were a cloud business. We were a cloud business before the cloud was a thing. And we put a bunch of telephony infrastructure in the cloud to put a bunch of voice recognition in the cloud. And we had this idea, you call on a phone and you start speaking to it and it reaches out to the internet, grabs data off the internet, throws it through a text-to-speech engine and reads you back information. So like literally 1990, 2001, whatever it was, you call up and you say, who won the Giants-Dodgers game? And it would say, Dodgers beat the Giants 7-1. And that data came directly off the internet. And that was mind-blowing to people. The bubble burst because it was going to be a direct-to-consumer play. And we realized like we were never going to be able to support it with ad services. And we had raised a huge sum of money back then. We raised $125 million pre-launch. And we had all this money in the bank. And the board was like, hey, like, you guys are all great. Like, what else can you do? And we realized that what we were sitting on basically was like the most advanced IVR system, phone system for corporations in the world. Like what we were doing was well beyond press 1 for your banking, press 2 for your checking account, whatever. And so we just pivoted the whole business into becoming effectively an enterprise SaaS telephony company. And over the next 4 years went from 0 to 100 million in ARR in 4 years. And Steve Ballmer was CEO of Microsoft. And in 2007, give or take, he decided he wanted to own Tellme. And he offered us $750 million. And the company Nuance, which had a bunch of speech recognition software, offered us $1.25 billion. And their stock was pretty volatile. And Microsoft stock was not very volatile. And we sold to Microsoft for $750 million. And then I decided to do venture. So yeah, it was like I had a whole career before venture, although the entrepreneurs today have never heard of Atom Network. They've never heard of Tellme Networks. Like it's so long ago to them, it's irrelevant.
Assuming it was a combination of cash and equity, I hope you kept your Microsoft equity because they're doing well.
So, for the first couple of years, I completely liquidated everything the minute I got stock. And Microsoft was trading like $13, $14 a share, I think it was at the time. And that stock didn't move for 3 or 4 years. And I thought to myself, thank goodness. But Nuance's stock went up like fourfold. So I kept thinking like $1.5 billion sale price times 4, $6 billion versus $750 million. Oh shit, did we blow it? And then here it is, Microsoft today, probably up 14-fold or something like that since then. Nope, that's okay. That's okay.
It's all right. It still worked out. Charles, over your years as an investor, I think since almost the beginning and including today, you've had the appetite and you've been very active investing in credit-driven businesses. I think Renault's Lending Club might have been one of your earliest ones, but there's many more, right? How has your thinking around credit fintech evolved? Because you've seen now a couple of cycles.
Yeah. Just for the ledger, my lending investments, Lending Club, OnDeck, Ox Money, Lending Home, which is now Kiavi, Upgrade, which is Renault's new company, post Lending Club, and Figure. Those are my 6. And I've gone 6 for 6, like all 6 home runs. So you'd think, oh my God, like, why didn't you do 26? And then if you asked me, like, when was the last time you did a lending company? I would tell you it wasn't last week, it was a decade ago. And so I do believe that lending is very exposed to cyclicality. It's exposed to interest rates and unemployment rate and GDP growth. And so there is a cycle, and you have to know about those cycles and how those cycles work, particularly for secured and unsecured businesses. Oh shit, I forgot Addy. We're an investor in Addy, which is buy now, pay later in Colombia. So that's 7. And there are times when the capital markets will be open and open for a while, when those businesses look quite interesting and they can grow incredibly fast. And there are times when the market decides that credit quality is going to weaken, interest rates are going to rise, spreads are going to compress. And you could just watch all the capital markets close on you, and you can watch your revenue just completely disappear. So there is a bit of nuance to it. And I would say that over the last decade or so, we've been more worried than not worried about the capital markets. And it turns out like obviously the rate increases that we've seen in the last 2 years have done a number, I would say, on a lot of startups. Ironically, our 2 largest, well, all of the companies that are now large are growing really nicely right now, like exploding nicely. I mean, particularly Ox Money in Germany and Kiavi here in the US are just like, it's like a hurricane tailwind behind them. But the mantra inside Foundation Capital, and I think rightfully so, has been, if you look at the word fintech, there's kind of fin, which is businesses where capital markets is the raw material, money is the raw material. And then there's kind of the tech of fintech, which is really more infrastructure to enable financial services businesses. And we've definitely more been investing on the tech side of fintech than the fin side of fintech.
Yeah. Yeah. And why do you think those lending businesses that you've just mentioned are doing so well right now, especially Kiavi and the one in Germany? What is it specifically about the last 2 years in a tough environment?
It's so ironic because in both cases, the CEOs were like, hey, we're going into this really tough environment. And so we're cutting costs. We're going to be really careful. We're tightening our credit box. And so expect we're going to see like pretty material revenue decline. And I think what happened was we hugely benefited from the cost cuts and we hugely benefited from the tightening credit box because credit has performed really well. But what we didn't expect is that because we were kind of material size at that point, particularly relative to the competitive set, we had access to capital and at capital at lower cost. So not just like at lower cost, but just having access at all. And because we had 7-8 year track records of credit performance, we were in market with product and with offers when other companies weren't. And so think of it, customer acquisition cost was way down because other companies didn't have the money to spend. So cost of origination was low. Credit quality was fine. Spread was good because our cost of capital was lower than everybody else. And we just took share. We've been taking huge market share. And I mean, just to give you a sense of magnitude, I probably shouldn't say this, but Ox Money in Germany did 10 million of EBITDA in Q1 and Kiavi did 19 million of EBITDA in Q1. I mean, these businesses are just spitting out cash and growing 30% quarter over quarter.
Yeah. I mean, it sounds like the strategy that Capital One did for years, right? They got aggressive in downturns and they gained market share. It's very interesting. We see it in our portfolio, credit-driven businesses, especially the ones in Latin America. They're actually doing extremely well. And I think there are some of these dynamics playing.
I just want to throw out one thing because I've been kind of like pounding my fist about this for, 18 months now, and it has not come true for the record. So I've been wrong. But I've always said that you have all these neobanks, debit card related startups that are all trying to build businesses on interchange plus early payday loans and avoidance of overdraft fees and all those things. And that's a very tough business with very low margin spread. And then you have lenders, which comprise 70% of bank profits. And so the lending business is the profit machine and the debit business is the product. And I've always said, like, you will see these lending businesses crash together with these debit businesses. And I always thought Chime would merge or acquire or be acquired by a lender, and Current, same thing, and Varo and Aspiration, and go down the list. Because lending is a much harder business than the debit card business, much harder. But if you're a debit card business and you have 2, 3, 4 million customers, that's real customer acquisition that you can plug in with the lender, and it's gonna be really profitable. And it's kind of crazy to me that we haven't seen it. And I think it's primarily because the lenders look at the debit card business and say, like with Bass, we can go spin up our own debit card pretty easily. There's no need to go buy somebody and dilute ourselves to do it. But I've just been watching that dynamic like closely.
That conversation might change now. We'll see. Switching gears a little bit, Charles, another thing that I know you're thinking about these days is just the value of data. And I guess this becomes even more important with the backdrop that we have of the last 18 months of just anything AI related, just like on fire. Absolutely. I mean, NVIDIA is just holding up the entire world.
$2.5 trillion market cap.
Yeah, it's insane.
It's holding up the value of my price in Silicon Valley. My house is like not going anywhere.
Yeah. So why are you thinking a lot about data as the core value driver?
I'll go back into the Wayback Machine for a sec, if you permit me. But when we were early on starting At Home Network in the mid-90s to go chase the internet opportunity, it was a very small community, and you knew Jeff Bezos when he started his book business, and you could like go down the list of all the startups at the time. Some have survived, some have not, Realtor, CNET, all the others. And it was a very easy formula in that you were creating an opportunity, a new business that mirrored an incumbent's business, but that the incumbent clearly had no advantage relative to what you were doing. So if you were Barnes & Noble against Amazon, it was pretty clear, infinite book catalog versus limited book catalog, the cost of brick and mortar versus the lack of cost online. And so there were just huge inherent advantage. And sure enough, over 20 years, John Doerr was right, biggest value creation the world's ever seen. So you're like, okay, now and then you saw it with cloud and mobile. So now here you come to AI and it's like, okay, surely again, with the innovations across AI, like we're going to see another massive 20, 30 year explosion of value creation from startups, ideally Silicon Valley startups. And it's just, I think there's a big question of whether that's true or not. And the entirety of the reason is that AI models ingest data, and they must ingest data. It's their oxygen. They need it to live. And when you say, like, who owns the data, who controls the data, it's not the startup, it's the big incumbent. JP Morgan has a lot of data, and no startup, no little neobank is ever going to be able to come close to the amount of transaction data, banking data, securities data that JP Morgan has. And so JP Morgan, it doesn't mean that they're going to be able to exploit all that data. And that's where obviously lots of companies are being built to help JP Morgan succeed. But the data, pick your analogy, it's either the oxygen or it's the gasoline or what have you. But like without it, we really don't have anything. And so unlike the mid-late 90s where every new .com startup had a great chance of success against the incumbents, today I feel like most of the startups, unless they're in kind of the tools enablement space, have a very large hill to climb against the incumbents.
And how does this translate into the types of business models that us investors should think about?
So we simplify way down sometimes internally in our conversations. Maybe we oversimplify, but we like to think of there being two buckets of startups that we see today in the AI space, and then as a subset in financial services and prop tech and insurtech. And we think of them as kind of prospectors of data gold, companies that are looking to find their own unique data advantage. And they're just like out there with their pans and their feet are in the stream and they're just like looking, where's the data? And then you have the purveyors, right? The guys are like, I'm not going to go out and break my back looking for gold. I'm just going to go sell the picks and shovels and I'll make plenty of money, enabling all those guys who are like panning for gold all day long. And so we know that the prospectors, if they get it right, if they find the gold and they can build a business around that unique data set that they've acquired, amassed, built, licensed, they can build tremendous defensibility and advantage, extract economics as a result of that, and build really big businesses. I mean, really, really big businesses. But that's a significant minority of what we see because it's hard to find the gold. It's hard to find the unique data. It doesn't just sit around where available for you to grab. What we really see most of is the purveyor. We see most of the, hey, I've got this thing I'm building that's going to enable MetLife and Guardian to price their life insurance in a more efficient way. Or I've got this thing that's going to enable the large banks to look inside the transaction data and figure out what product to cross-sell, right? So it's utilizing somebody else's data for better decisioning, better action, more efficient action. And they can build good businesses doing that. But if you say, like, what's the competitive advantage, the long-term advantage, it's never going to be the data. It's going to be the more esoteric things like UX, UI, first mover advantage, long-term contracts that can lock up an industry, distribution partnerships, right? It's going to be a different set of things that are going to determine how big a business like that can get. And so that's our simple model. It's a prospector and purveyor.
And if you're a prospector, first of all, as you've said, it's much harder, of course. Is it usually a winner-take-all model if you're a prospector?
I think it does. It's probably winner take most, right? Like if you lock up data, if you lock up data from 4 of the 5 largest banks, could somebody else still get enough data from the mid-sized regionals to build whatever you're building? Probably. But it's kind of like Plaid, for example, right? Like Plaid, in a sense, like it's not data, but the depth of their connectivity is amazing. And each provider they're connecting to thinks to themselves, like, do I really need to have more than one connectivity pipe? Probably not. And so that is pretty much winner take most, almost all in a case like Plaid. And I think similarly, if you have found a way to like extract the gold, you're going to do your darndest to make sure that it's proprietary and it's exclusive to you. And so, yeah, it's going to be winner take most, if not all.
And when you think of, say, your portfolio, are there any examples that come for both prospector and purveyor?
For sure. I'll give you a couple examples of prospector. Obviously, we're very excited about them. One of them is called Evolution IQ. And Evolution IQ is in the disability and workers' comp business. And so for those that don't know, those are two really unusual types of insurance because unlike a car accident where it costs $43,000 to fix a car, and you can quantify that specifically and therefore price insurance, disability, which effectively is like getting injured not at work, and workers' comp, which is obviously getting injured at work, says that you're going to get compensated for so long as you are unable to perform your job. And that could be a week or a month or 35 years. And so it's an unusual form of insurance because the cost is in some ways almost unbounded. And so it's really important for insurance companies to kind of understand those that have submitted claims, what their issues and challenges are, and what the expectation is about whether that should be a 1 week, 1 month, 1 year, 35-year claim. And so they have these claims analysts who just pick up a random claim in a day and say, okay, Mr. Jones, let's see, like, oh, you hurt your back, fell off falling off a ladder, and sure seems like after 6 months you should have been back to work because the doctor said, like, you can bend over. And there's like 100,000 claims on any given day. Like the adjuster's like pulling some random claim and spending half a day looking at it, and maybe it was a waste of time, maybe it wasn't. And Evolution IQ is like, give us all of that data. And they do it across all the carriers. And they look at all the unstructured data and the structured data, and they make sense of it all. And they look at past closed out claims where they know people got back to work. And they say, of all these people who are not at work, who is more likely to be able to perform work again and soon? And let's focus our attention on getting those people back to work. So it's like a great proprietary data set because the insurance companies' individual data sets aren't large enough and have really no technical capability of ingesting this data and using AI and machine learning. And so what they have now built is definitively the industry standard of how to evaluate a claim for disability and workers' comp. And so they are a prospector. They built a huge pile of gold and they're monetizing it to the tune of like tens of millions of dollars of contracts with carriers. Amazing. The second I would say is one of my lenders that we talked about, Kiavi. So Kiavi today originates loans to about $7 billion worth of fix and flip home transactions, right? These homes that you or I can go out and we buy for $300,000. We spend 6 months fixing it up, ripping it out, putting a new kitchen, new bathrooms, making it look nice. We flip it and we sell it. We make a pile of money and we go do it again and again and again. That's the fix and flip business. And they do about $7 billion of loans a year. So now for every single home that is purchased that they're providing financing for, they know everything about that home and everything about what the general contractor is doing to fix up that home. So at this point, they can look at a home that has not even yet been sold, but is on the market. And they can say to a fix and flip individual, if you buy this home for $347,000 and you put $87,000 in and you turn the 3-bedroom into a 4-bedroom and you replace the 2 bathrooms and you put in a gas stove and a new fridge and you put on a new roof and you put sod on the front, you're going to sell it for $445,000. And we'll bundle the financing. So you're ready to go. We've already pre-qualified you. We even have a general contractor who's willing to do the work at the price we said. And it's just like just add water and stir. And like that data set is completely unique. And it's enabling them to like take market share like crazy because they're not waiting around for somebody to say, hey, I found a project. Can you lend me money? They're like, hey, developers, like here's a bunch of projects. Pick one and go and we'll finance it. Yeah, really cool.
Yeah, what I like about those two is that that data set keeps growing as part of their business model.
Yeah, it just gets better and better and tighter for sure.
Charles, talking about founders, I always enjoy talking to you and any experienced investor specifically about founders because you've seen so many, you've worked with so many have worked out, others haven't. But what have you learned about founders? I know you have a way also of thinking of the two types of founders, but what have you learned about working with founders in your portfolio, the ones that have succeeded, maybe the ones that haven't? What stands out?
Do you know this podcaster, Lex Fridman?
Yeah, of course.
right? His podcasts are like 5 hours long.
Yeah, I haven't.
Like, you just asked me like a 5 hour question.
I have time. Let's do it.
Yeah. I mean, if venture capitalists knew the formula for what was a good founder, I suppose the venture capital business would be super easy and we wouldn't make a lot of money because all you'd have to do is run the checklist against the founder and decide whether to put in money or not.
Or maybe the AI can run the checklist.
Wouldn't that be nice? The reality is there is no prototypical founder, and we've not been able to figure out the set of personality traits that would suggest that one founder could be successful or not. For example, we have founders that are incredibly technical, introverted, and couldn't sell their way out of a box. Like, no way. And we have founders who are non-technical, who are kind of just incredibly expansive in vision and thinking and can get like anybody excited and can sell like rocks in a box. And so there is a question of like, what do we look for? And I think the answer is nuanced because what we look for is specific to the opportunity. And that's what I think most people miss, which is the opportunity in some way should dictate the experience and knowledge and personality type of a founder. So like, for example, if we see a business, let's say one of these classic businesses where you meet the company and then like 3 weeks later, there's 4 competitors running up and down Sand Hill Road looking for funding. And you're like, oh my God, there's going to be 5 of these. And we got to make sure we pick the winner or we shouldn't be in the category. That happens all the time. And I think of that as a race condition scenario. And in a race condition scenario where the opportunity exists, I need a founder who's visionary, expansive, big personality, somebody who can recruit people fast and motivate teams and get people working intensely hard and create the environment of a race condition, the wartime CEO kind of thing, where it's like live or die, to kind of grow into the leader of the race condition. And like, that's a great, what I call kind of founder market fit. And conversely, if I take a, let's say, highly technical, introverted, quiet founder who can be amazing in developing some incredibly hard tech that's going to take 1.25 years to build with 20 engineers, and you don't need a business person at all. And once it's built, its value is so obvious that you can then go to market team and sell it. If I take that founder and put him in that race condition company, it's a train wreck. Like, that business will fail. But similarly, if I take the race condition, expansive, extroverted founder and put him in a 18-month dev cycle, deep tech company, like, that company will fail. And so both of those founders can be successful. Both of those companies can be successful, but you absolutely need founder market fit. Nobody talks about it. People talk about product market fit. People talk about like, what are traits of good founders? But in my experience, there's so many types of founders that can succeed. But what's more important is their fit with the job at hand.
And just to dig in on that a little bit, how do you incorporate into your model, another way of saying, how do you price in the fact that an industry can change and it's harder for an individual to change, to adjust?
It's a matter of being disciplined. It's like one of the hard lessons I've learned in venture. You try to learn from your mistakes, but you continue to make them throughout your whole career. Like, I assure you. And one of my susceptibilities, one of my weaknesses that I rely on my team to like keep me on the straight and narrow about, is that when you find a company that's pretty good, that's like 80% good, the inclination is to think, if it's 80% good, and instead of paying 100% price, I pay 70% price and I get a good deal, I should make the investment. You know, the company is 40 million pre, it's 80% good. And I think, God, if I could get it at 30 pre, that'd be a really good deal. I should do it. And the reality is, you should never do it. Never, ever do that. If the company's really good at 40 pre and you're blown away by it, you should pay 50 pre or 60 pre, because if it's worth $3 billion someday, nobody's going to complain that you paid 60 pre versus 40 pre. So that bias of like wanting a deal, looking for a deal, which is innate in my personality, I guess, from my upbringing, is something that I have to override, because it'll get you in trouble for sure.
That certainly helps me think about our current complicated and hot pipeline that we have to sort through.
Yeah. I'm sure like we all in the industry can fall victim to that. It's kind of, there are so many of these little corollaries. Another one that we talk about a lot, which I think is similar to this, is when a company comes in, it's so easy to look at the company and say, oh my God, this can go wrong and that can go wrong. And they probably won't succeed here and they won't succeed there. Like, what can go wrong is the obvious question that everybody asks and that you debate and evaluate. But that's not the right question. The right question is, what can go right? But it's a harder question to ask because the what can go wrong is staring you in the face and can or may not go wrong. But the what can go right, you feel like is a pipe dream or it's fantasy. You don't want to bet on it or rely on it. But in venture at the early stage, you have to kind of be willing to dream. You have to be willing to say like, oh, shoot, if these three things occur, wow, like maybe the whole market would change. Maybe it could change.
You can kill every single opportunity of asking what can go wrong, right?
That is for sure. And when we look at, 1,000 things and we only do 8 or 7, you kind of do need to kill 993 things. So it's easy to fall into that what can go wrong trap for sure.
Charles, one thing I wanted to ask you about is something we talked about years ago, and this might have been recorded in our first episode, I don't remember, but it's about time to sell, right? We think about making the investment, doubling down, but obviously we also have to spend time thinking about when to sell, when to return capital to our esteemed investors. And I know you had some heartburn in this subject in the past, but what have the last cycles taught you about getting some liquidity?
For those that don't know venture lingo, as it were, what you're asking about is what we call DPI, distributions to paid-in capital. How much money did the LPs give us and how much have we returned against what they gave us? In contrast, TVPI, which is total value to paid-in capital, includes what you've given back, what you've distributed in cash, but also the current mark of things, how much things are being carried at. And in 2021, 2022, when all these crazy rounds were getting printed and unicorns were being created every day, every venture firm looked like they were geniuses because their total value to paid-in capital, their paper gain, TVPI, was massive, 7x, 8x, 10x. But the amount of capital they gave back to the LPs was like tiny or nothing, because in that kind of market, every entrepreneur and every venture capitalist are dreaming, wow, like my company was worth 400 million. Now it's worth 2 billion. If I just wait another year, it's worth 4 billion. And every doubling of a company at that valuation creates 30 or 40x return. So like your desire is to see it go to the moon. And you know that the venture business is all about outsized returns, and therefore you never want to sell. And that's the trap, right? The trap is you're kind of constantly playing the top tick. And if you try to top tick, you're never going to succeed at it. And so it just demands that we need to not dream about what could happen, but we need to, I think, be grounded and say our job is to return capital to the people that gave us money. Like our job is DPI. And it's okay to like keep some of the capital in play and bet for the home run, but it's not okay to bet everything on the home run and then watch it blow up in your face. And so I believe like our business demands that we drive to DPI. Now, I think there's a nuance to it. Some firms, including Foundation Capital, they've decided that we're not good at making the sell decision. We're good at making the buy decision. And so we're going to leave the sell decision up to our LPs. And some firms distribute the entirety of their position the first day they can. Union Square Ventures, like by example. That's like an easy way to say, you know what? That's not our business. We got it to the stage. Let the LPs figure it out. Other firms, I think like Foundation, try to find a different approach, another rational approach, but different. And we say, you know what? Like, we're going to sell some amount the first day we can. Maybe it's a third. And we're going to work a third out of our position, let's say over the next year, if we can. And then maybe like that last third, you've more than paid back your investment. Maybe you've more than paid back your fund. And now you can kind of use some judgment and optimism around what could happen for that last third. And if the last third goes to the moon, great. And if it goes to zero, you've already delivered a bunch of return back, and that's okay. So kind of there's these models like a third, a third, a third. I think there's a kind of a nuance that I learned from some PE friends that I try to apply, which suggests that a third, a third, a third is a good model, but that specifically, let's say to public markets and to a lesser extent, private markets that follow public markets, there are times when trading multiples, acquisition multiples are at their extremes. And there are times when they're at their depressions, at their troughs. And then there's times when you're kind of in a a middling market, which suggests that you're not overhyped or underhyped. And I would say the tweak that I would suggest is pick a range. If you're within 60 or 70% of the standard trading range over a 5-10 year period for that industry, your industry is traded at a PE ratio or PEG ratio of X to Y, and you're inside that third quartile, whatever it is, 1/3, 1/3, 1/3. But if you're at an extreme, let's say, optimistic state where it's trading at a 50% premium to the top number, push it out as hard as you can. And if you're at a trough and like stocks are depressed, just wait. Why do it? You're trading at 1 times revenue and the market trades at 4 to 7 times revenue. Just be patient because all these industries have cycles. And so I would say try to have some pretty good rules, but modify when markets are at the extremes. And I think the industry did a pretty bad job over 2018 to 2021 of just like being like full greed, pedal to the metal, and not being mindful of DPI. And I think the LP community, they talk about this kind of denominator numerator problem where basically they had all this markup. And so the private equity portion of their whole portfolio suggested they were way up, but they were getting back no cash. And so they were over allocated and stuck because they had no cash coming back. And I think our industry has a job of recycling and returning money on a constant basis.
And on that point, Charles, who do you consider your customer, the founders or the LPs? I
think we have to operate with the mindset we have 2 entirely different customers. We do. If we serve the LP community and shun the entrepreneurs, then we have no business. And if we love entrepreneurs and we never return any capital to the LPs, we have no business. So yes, I get the question, but in reality, we have 2 customers that we have to serve and we have to find the right balance on both sides. We have to be fair and honest and encouraging of our entrepreneurs, but we have to at times be honest with them and tough with them. And we have to act in the best interest of our LPs, but at times also know that our LPs sometimes rely on our judgment more than their judgment. So sometimes they might want us to do something that we don't do because we don't think it's in their own best interest. And so we have to find that right line of not being subservient to our LP customer, where we think we actually know something more than they may know because we're closer to it than they are, but not also just be arrogant and not listen to what they have to say, right? That would also be a turnoff for them. So you got to strike a balance.
Super helpful, everything you've been sharing, Charles. Before I let you go, something I've started asking all the guests is any books that you'd love to recommend? Doesn't have to be business, could be business, but any 1 or 2 books that you revisit often that you'd like to recommend?
The other day, I had dinner. I met with the Freedom Caucus. Remember Yang ran for president on this like income for all platform. Anyway, he's repurposed himself, and I had dinner with him to talk about this new Freedom Caucus he has where he's really trying to push for ranked choice voting, which is kind of a centrist position on trying to get people to back and support politicians who are more centrist than the extremes, right? Because we have this dynamic where only the extremes get media coverage because they say crazy things, and only extreme people vote in primaries because nobody else is motivated to vote. So then you get these crazy politicians, and instead this ranked choice voting kind of pushes everything to the center. And so he gave out a book, which I've been reading at the dinner last week, but politics is a dangerous topic, granted. And I've been struggling myself with, I would say, the health and state of our democracy and my fears, my personal fears of there's a risk in my mind that social media, fake news, AI could actually lead to, I think, the end of the concept of democracy. Not intentionally, obviously, and that it might be that when you don't know what is true or false, and when the distribution is so frictionless, that it might lead to the only structure of government that can control that is more of an authoritarian structure of government. And that, of course, scares the crap out of me. And so I've just been trying to kind of learn more about ranked choice voting and on the margins what I might do and what the Freedom Caucus is trying to do to encourage the democratic system to stay healthy in a state where it's being challenged.
Charles, amazing. I learn every time I talk with you. This has been very helpful. I'm sure people are going to enjoy it. How can people reach out to you?
Easy. C. Moldow, MOLDOW @foundationcap.com. I would say it's definitely better than hitting me up on LinkedIn. I would just say, just email me. I'm pretty responsive on email.
I can confirm that. All right, Charles. Thank you.
Yep. Always a pleasure. Great. Great talking to you.
Thanks for tuning in. I hope you enjoyed this great episode with Charles Moldow. If you want more interviews, make sure to subscribe, follow, and leave a review on Apple Podcasts, Spotify, or wherever you get your shows. It helps and truly means a lot. And if you have any suggestions or thoughts about the show, just drop me a line on Twitter or LinkedIn. Signing off till next week, I'm your host, Miguel Armaza.